Hey, good morning, everybody. Welcome to the Energy News Beat. My name's Stu Turley, President and CEO of the Sandstone Group. And I'll tell you, I got a great privilege today. Boy, I can't even talk. I'm from Texas. Privilege today with Tim Pawul. He is not only the president of Minerals and Royalties Authority, he's also a fellow podcaster running down the road. So, welcome. Thank you very much for stopping by, Tim.
No, Stu, thanks for having me on. I'm looking forward to a good discussion.
Oh, there's something about being a podcast host. What's the most frightening thing you've ever had to face as you got started?
No, not frightening. I think it was more if people really understood the limited barriers to entry in doing this, I think more
Yep.
people would. It's the concerns of how do you distribute it? I need thousands of dollars of equipment. The quality is not going to be good. And really, at the end of the day, as long as you have good quality conversations and good people on, you can
Yep.
produce good content and you can do it anywhere and very cheaply and seamlessly, right? So once I got past that, it's been happy days, and I've really enjoyed it. And there's been a tremendous amount of benefit from it. Meeting good people, new relationships, and the marketing aspect of it is phenomenal. So
And what we have found, as well as just industry thought leadership, it's so fun to be able to sit out. And who would have ever guessed that I was at a checkout stand the other day and Tim, and I'm sitting there and the guy goes, "What do you do?" And I go, "Well, I don't want to tell him everything I do." And I just said, "I'm a podcast host." And he goes, "Really?" I'm
So,
like,
so I say the and this is me stroking my own ego here of maybe reaching minor celebrity status in my own world. I'll go to during COVID, right, is when my podcast started, and so
right.
people weren't really seeing each other a lot. And so within the mineral space, the podcast has gotten my podcast has gotten a lot of traction because it's
Yep.
focused on the mineral space. And I was at this reception at a golf course for the first time, people seeing each other, and someone's like, I recognize that voice from across the room. And I'm like, well, that's a little strange, but I'll take it.
Isn't that cool?
Yeah. Yeah. So you gotta take the wins and you can get them, right, Stu?
Oh, it's a small win. Both of my fans are, good people. And,
That's right.
when you sit back and kind of realize that. Now, Tim, you brought up the point that your podcast is around royalties. And we're in a energy crisis right now. We're in an investor crisis. We are in inflation. Tell us what some of the things that are best going on your podcast around oil and gas royalties.
Yeah, well, listen, I think the reason I started my podcast is that if you're an investor, and I think the interesting thing about minerals and royalties investing as an asset class is there's no capex exposure, and so you can invest into a real asset that gets exposure to commodity prices without exposure to ongoing costs, and so that becomes attractive to a generalist or someone who is based in another country who doesn't want to be able to run an oil and gas company from a traditional sense, right?
Right.
Running equipment, running a team, et cetera. You can do it very lean. And so I think when you look at the universe of yield hungry investors, alternatives to fixed income, alternatives to the bond market, minerals and royalties becomes a really interesting opportunity. Now, they've been as an investable asset class, it's been around for as long as oil and gas has been around, but they always say that it was the best kept secret of oil families in Texas. And so in 2014, 15, when institutional capital came in and really scaled this space, public started to form. That's when I started to focus on it and have gone down the career path that I have today. There's an ongoing effort by myself, by every mineral CEO out there, all the conferences and publishing content mediums out there to bring awareness to the space because it is a great alternative asset class. And
Mm-hmm.
I think one of the pitches has always been it is a hedge on inflation. Now, there's times where the features and the benefits of certain things are more valuable in and
Right.
out of economic cycles. And right now, a hedge on inflation is a very, very powerful, sub note here on an investment pitch for Minerals
Right.
Royalties. And so I think the companies that I know are fundraising, the private equity firms that are raising specialist royalty funds,
Right.
have said there are different types of investors, in conversation with them about investing in minerals purely for the inflation hedge. Absolutely. And I think, we're seeing it with oil and gas prices finally rising high. I mean, God bless all our brethren in the space, service companies, E&P companies who
Right.
survived 2020 and 21. Now prices are up and they can become more profitable, which is great.
Right.
But service costs are up, and I'm paraphrasing, private conversation. Someone told me 30%. So
Yep.
that's real costs. You invest in minerals, you don't get exposure to a 30% increase in costs. You get exposure to 100% of the increase in commodity prices. Now, when prices go down, obviously your revenue goes down, but that's
Right.
one of the major benefits, and it's a real asset as well. So it's not a stock, and that has a lot of appeal to folks. The way to think about it is it's underground oil and gas real estate. A lot of real estate families and investors,
Right.
it's an easy jump to make over the fence to
So
minerals
you're not
investment.
having to day trade.
No, exactly. Listen, I think you can day trading, aka flipping minerals, is
Oh,
always a game, but it's
I didn't know you
riskier.
could do that, Tim.
Yeah, there's a market out there, but but brokers have a bad reputation.
Mhm.
Part of the ecosystem. It always will
Right.
be. There's a place for it, but purely doing it day in day out to make a quick buck, that's when you can get caught holding the bag when commodity prices go down, or your capital goes away,
Right.
or you're over levered, or whatever amount of scenarios can go wrong, and then you're no longer in the minerals business brokering. You're out on the side of the street with the change cup. So I think,
Change cup.
yeah, I think the the idea of investing in minerals is a long-term asset class. That's where you can really realize the yields over time, and you can ride out the cycles, just like anything in the stock market. If you can time it correctly, which no one has,
Yep.
a crystal ball, you can do well, but you can also lose quite a bit as well.
So what are you hearing from all your sources about the Reuters put out this morning about Saudi Aramco saying that there's not enough money for drilling going into it. And then you see all of like last week, BlackRock said, oh, we're not going to listen to our ESG investors anymore, and we're going to go ahead and start investing. The next complex piece of that is Chevron saying, we're only going to modestly increase our CapEx spending. And then you just mentioned, Tim, very well, 30% increase on the guys drilling a well. So even a modest increase is not going to help the cost of oil. So, but what is a solid thing throughout this whole formula? It's royalties, isn't it?
Yeah, well, let's focus on from what I understand, the first part of your question is where's capital for development on the
Right.
E&P side? Without E&Ps drilling your minerals, you don't have royalty income, right? And I think there isn't necessarily money running back into the space, but natural gas at $8 and oil at over 100, it's
Yep.
real easy unless you really, kind of change yourself to the wall on ESG. You see people starting to waffle a little bit, or find the returns are so insane right now that investors will start to circle back, right? And they say, hey, we want to ride up this wave and make and participate in some of the profits. I think they're breaking down the investor camp. There are some that by law cannot invest, and there's restrictions.
Right.
For instance, I work closely with a lot of groups in Europe. There are, it's called the SFDR decision tree, and there are articles in that if
Okay.
you have to on every investment make the claim, is this a sustainable investment or not? And
Hmm.
it's very politicized, but the idea is oil and gas, you cannot invest in it, or you cannot market your fund, i.e.
Right.
raise funds. And so as a result, a lot of the investors, even if they wanted to, could not invest in oil and gas. A lot of folks, the rhetoric is generalist money is running away from the space, and they think oil and gas is evil. I think people are a little bit more pragmatic than that. I think it's the framework of investing in oil and gas which is challenged. So that's number
Right.
one. So there's a whole camp of investors that the rules have changed and they cannot invest in the space anymore. There are
Right.
those that are coming back, and will do so modestly. I think family office capital, because they don't have investment committees for the most part,
Right.
and are going to participate, drill co's, right? That those types of structures. And then I think private debt. I think commercial lending is very constrained. A lot of banks have left the RBL space. When you have an RBL, it gets redetermined all the time, and so in a volatile commodity price market, that can really restrict you as a company. And
Yep.
so private debt will be more expensive, but hell, with gas prices where they are and oil where it's at, you could have 80 to 100% returns at the wellhead on a drill co. So if your
Right.
debt costs 40%, who the hell cares? And so
Yeah.
that, I think, in the short term is where some of the capital comes from. What'll be interesting to see, you mentioned the Middle East and global macro dynamics is
Yep.
do we increase drilling and get off of that discipline that was really beat into the market over the last few years? And I think the answer is private will, and the privates are. Now, will the public markets allow publics to increase drilling to meet these, the so-called supply gluts with Europe
Right.
and prices at the pump soaring? And is there going to be public sentiment to increase
Right.
drilling to balance that? We'll see. But I think time will tell. I think between the Ukraine war and the implications of that, between the continued need to be disciplined and drill, and also constrain infrastructure to bring stuff to market, you could make an argument that prices sustain themselves for the foreseeable future. I'm not going to go out beyond 12 months, but you could see prices
Yep.
staying up. And if it's not $8, it's $6, or it's 80 or 90 or $100 a barrel. I still think those are wildly economic for a lot of development out there. And
Yep.
to underpin it all, if you're a mineral owner under all this activity, this is fantastic, right? Because you're getting your stuff drilled, you're getting flush production at high oil prices and gas prices, and this is phenomenal for sure.
Now, how easy is it for folks when you're talking to investors, accredited or non-accredited? It's pretty easy. It's not like just dialing up your broker and saying, "Hey, give me 100 shares." But you do this for a living. It's pretty easy to invest, isn't it?
Yeah, I mean, there isn't a liquid exchange. I
Right.
think there's a lot of folks in the blockchain world that have visions of securitizing royalty interests and having them freely traded. I think we ultimately get there at some point, but that's a very complex, heady issue around land rights and
Right.
getting the SEC involved in the regulatory framework that needs to happen. I think you're starting to see asset-backed securities, ABSs, becoming very in vogue. There's scale needed for that, and so PDP, wellbore only, working interest in royalty deals
Right.
are a good fit for that. But in terms of investing into it, Reg D offerings into private partnerships is the most common form of being able to invest. You have to be an LP. I think the tricky thing about minerals, if you want to invest direct or
Right.
co-invest, you need to manage them. And so there's quite a few companies that will manage that for you. They have tech-driven services. This is what they do every day. And we'll just kind of give a broad range, 5 to 10% management fee per year to handle all that.
Right.
Making sure you're in pay, making sure your interests are accurate, keeping up and, on top of lease terms, etc.
Right.
That's I think the barrier for just anyone to just invest at any moment is
Right.
you're going to have some sort of level of sophistication. If you invest as an LP in a private partnership, though, you
Right.
can get access to that yield without those headaches. And so the management fee you'd be willing to pay in a fund structure would give you the peace of mind for outsourcing that operational talent. And then depends on the strategy. If it's buying into established production and it's just more of a blowdown type PDP framework versus going ahead of the drill bit and you're really backing the jockey to have the technical know-how and the land know-how and the relationships to buy correctly is key. So yeah, that answers your questions. I would say there's more and more opportunities to invest and partner with teams, but it's not as simple as opening up your laptop and going on and
Yeah.
saying, give me 100 shares of X, right?
So the best thing is to find an expert like you. And
well, yeah, I mean, listen, one thing I do, I think I'm not technical by background.
right.
And so I'm not going to be an advisor who goes and identifies properties and then does the engineering and says, this is a
Right.
13.5% return, you should put your money in. My expertise is knowledge of the players in the space, what they're doing,
Okay.
who they're backed by, and also having access to them. And so I work with a handful of family offices internationally,
Right.
advising them into forming partnerships or identifying the right teams for them to invest in or alongside of. That's where I'm
Right.
best fit. It doesn't have to be an international office. It could just be someone who isn't a sector specialist. I think that's where I'm best suited. I speak with sector specialists, i.e., minerals CEOs, all the time,
Right.
and they have their own Rolodexes and a very intimate knowledge of what's going on in the market. I'd say I know what's going on more than them just because of the nature of what I do,
Right.
but I can add more value to someone who's coming in and saying, this is my investment criteria, this is the yield I need, this is how long I want to lock up my money, they go down the list.
Right.
And then I can introduce them to the appropriate players that would be able to deliver those returns in
Yep.
the investment product or framework that they are comfortable with as a family office, as a institutional investor, et cetera. So that's kind of where I play in
Okay.
the framework that you're talking about.
I'll tell you that's pretty darn cool. And we as a company at Sandstone, we're able to help EMP operators with their data from the well pad to accounting. And so we see the other side of this from an EMP space and so we're not on the royalty side of it. So this is really fascinating on hearing it from that side. But when you sit back and take a look, horizontal versus vertical, I mean, you start taking a look at some of the lats that we're putting in, they're huge and long. How has that really impacted the royalty space?
I think there's no coincidence that scale of dollars, institutional money, came into the mineral space a little bit after the establishment of the shale boom. It's because you can get flush production and tremendous returns in a short period of time, whereas vertical production, it's just it's a lower capital, lower return, lower volume of.
Right.
Ultimately, volume is what drives your royalty revenue, right? So it's a
Right.
lower volume game. Is there still a play in the mineral side to buy vertical production? 100%. Low decline, predictable,
Right.
great for an insurance company or a pension at scale and wrapped into a portfolio. You can hedge it. But going back to your question, 2011, 12 is when the first private equity firms came in. And I think that's because they could put 50 to $100 million to work. The NGPs, the NCAPs, the KKRs, putting $5 million to work is not really that exciting. That's what family offices and high net worths did forever. Building little personal portfolios of $1 million, $5 million that kicks off 15% yield is fantastic. Where that's not S&P. that's a great alternative. But for private equity, you need value creation in a, call it a 3 to 7 year period, depending on timing. You need 20% plus returns.
Right.
And so getting ahead of the drill bit and then guessing that correctly, and then having a bunch of barn burner shale wells drilled and getting that flush production is how you make that private equity model work. And so that really, I think, is the main game changer, is the scale of production and making it a more investable space for institutions.
Man, this is really cool, because this is a whole side, Tim, that that you don't see on the production side when you're over here trying to figure all this kind of stuff out. And how did you get involved with the family offices? Because that's pretty, how did you find, because that's a tough animal to find sometimes.
Yeah, it's just relationships and grinding and referrals, and you build
Okay.
trust with people. I think that's really the end. There's no nut to crack on that. There's no silver bullet. Believe me, my job is to continually expand my network every single day,
Right.
and be the guy in the space that knows everybody, that can connect you with folks. The family offices are extremely private, and if
Right.
you don't know someone that they know and trust, good luck, right? So listen, I run the biggest content platform in the mineral space, and I'm pumping stuff out every day. So that, in combination with having relationships with essentially every management team in the mineral space, being out there for a while, all that yields a couple of good relationships per year. So you reverse engineer that, and it's just if you deliver for them and do right by them, and then that begets future relationships, and that's just kind of the ongoing game of it, right?
You have, I think, 12,000 LinkedIn followers and everything. That's pretty good. That's how I've been following you. So or stalking you. I'm not stalking, following. I'm not sure.
Yeah, that I appreciate that. I worked, before I started my minerals advisory firm last year. I worked 8 years for an entity backed by Blackstone called Energy Council. Energy Council was a professional networking platform geared towards investors. And so my job was to run Latin America, the US, and Canada, and speak with debt and equity investors, CFOs, and CEOs on an ongoing basis, and then organize one-to-ones. And so the nature of what I did for almost the last decade was to build a large network. And so just by osmosis, I grew a personal network on LinkedIn through that. So wasn't how I chalked it up on the whiteboard day one, but you look back, and it's the beauty of life. You go down a path and go through the doors that open themselves, and here we are. I'm a mineral specialist, so I'm enjoying the ride.
How fun.
Yeah.
If there was somebody out there wanting to be a podcast host or wanting to get started, what are some of the key things that you'd recommend?
I would recommend picking a lane and getting very good at it. You don't have to be relevant to everyone. You have to be relevant to the right audience.
Oh, I like that.
And so I think trying to be all things to all people, it can be done. We'll use very drastic examples. Joe Rogan. Joe Rogan is the largest podcast in the world, and he has everyone on.
Right.
Why can he do that? Because he has the relationships and he has the audience.
Right.
If you're starting from scratch, I think if you're the other thing is you have to be passionate about it.
Right.
If I think a lot of folks started podcasts during COVID because of they didn't, you got more time, you're at home, or you're trying to create marketing and biz dev opportunities because you can't travel anymore.
Right.
And then they're not really into it. And it's almost like a gimmick, and it flames out, because to continually do it every single week, balancing personal and business travel and obligations, it's a commitment. And so if you don't really enjoy it, then I think that's one challenge. But yeah, going back to, I think picking a lane. If you're really relevant to a certain audience of people, then you're going to deliver a ton of value. If you're jumping all over the place, it can be difficult. And then what ends up happening is just you don't really get traction with anything. And so I think
Right.
that's where I went in. I think when I was with Energy Council, I did a lot of things. I covered 3 geo markets, the entire oil and gas value chain, and I knew a lot of people. And so I was a big podcast consumer
Right.
on a mix of business
Yep.
and also kind of personal entertainment. And I always wanted to do one. And one, going back to your earlier questions, was a bit skittish because I was like, oh my God, how am I going to do it? What equipment do I need? How do I get started? And then when I got over that, it was okay. Well, I'm busy. Like this will be a lot of fun, but what's the relevancy? And then just the aha moment of basically every other conversation I've had in the mineral space. Hey, have you known any other family offices? Have you known any other institutional investors
Right.
that are investing in that want to invest in a fund or buy a turnkey asset? Let us know. And I was like, this is the request I get the most. I don't have any tricks
Right.
to find these people outside of
Yep.
the next person just cold calling or meeting them serendipitously. So let me create content where there's no content. And so
Right.
that would, maybe they'll come across it and then they'll come across my desk. So that was a very unique and lucky timing to
Yep.
create content in a space that didn't have content. So I always kind of laugh with my old colleagues. I go, it's innovative to have a newsletter in the mineral space. Like that is like annoying spam in any other part of energy. But in
Right.
minerals, there is no concentrated content around the mineral space. So
Right.
pretty value add. So that in itself is kind of lucky, but analyze all these things. What audience am I trying to target?
Right.
What's the way to be competitive or unique? Is it your individual knowledge? Is it your guess? Is it
Right.
analytical insight? And just combine all that and find a lane, and then don't be worried about it being perfect. Just pump the content out. That's the one thing people don't understand, that I don't proclaim to think everything I do is perfect or the
Right.
highest quality, but the reality is it gets better. It's
Yep.
gotten better over the last 2.5 years. I've gotten better conversationally. The
Yep.
quality's gotten better. My editors have gotten better, and you learn tricks. People get so hung up on the perfect piece of content. And I'm
Right.
going to be honest, no one cares. Like they're going to tune in, you add value to them for 30 seconds to 50 minutes.
Yep.
It might spur a conversation or a call or a meeting in that moment, and then they're going to move on to the other million pieces of content. So stop putting all your money and time and resources into producing one piece of content. Make it quality and regular and pump
Right.
it out. And over time, you
Yep.
will realize value. Some conversations and episodes are going to stink, and
Yep.
some are going to be really cool. And so that's my long-winded answer to that.
I love that, Tim. Some of my podcasts get 5 views. I'm getting on that. And in the past, some have been up to 40,000. So you sit back and kind of go, which one's going to hit. My sense of humor is so bad that people want to hear just every single one of them. So, when we sit here and take a look at where you're going next, what's next on the corner for you? What's the name of your podcast first, so we can put that in the show notes?
Sure. It's a very innovative name. It's called the Minerals and Royalties Podcast. So on that, by the way, since we're talking about kind of deconstructing a strategy, there's a guy I love listening to. His name is Gary Vaynerchuk. He does a lot of content.
Gary.
He talks about the beginning of his career. He's always been on the forefront of Google AdWords and YouTube, and
Right.
he saw a lot of these patterns early, and he leveraged them for business purposes. He talks about when he built his family wine business, that he did it on the back of Google AdWords when it was 1 to 2 cents a click, right?
Right.
And he said at that time, no one was doing it. And so he bought all the categories for wine. And because it was so cheap, he would buy red wine, white wine. He didn't have to do 2017 Zinfandel from this winery to get down to 5 cents a click, right? So I remember that, and because he said, own the category if you can own it.
Like that.
and so I remember when I was named, I started the podcast at my previous company before spinning out into my firm. And they were like, oh, let's call it this, let's call it that. And I was like, why are we getting so cute with it? Like, if people, I want people to stumble upon this, they're not going to search the podcast specifically, they'll stumble upon it. Call it what it is, the Minerals and Royalties podcast. No one is doing content.
Right.
I'm going to own the category on, on searching podcasts or whatever. So that, the other thing on just kind of naming it and everything, everyone wants a kind of a cool name, but be sensible on what you're looking at too. If it's a crowded space, I think you maybe have to be a little bit catchy and everything. But if you're lucky enough to enter something that
Yep.
isn't competitive, don't, you know, maneuver your way out of
All right,
attention.
Tim, I'm going to be a little gruff here. Where were you when I named the Energy News Beat podcast? All right, I could have used some better advice there.
Well, listen, what is your podcast about? It's about energy news. I don't know. I think it's as simple as that. And then if you create good quality content, people will go back to it. I mean, the Joe Rogan experience. What is that? Who cares?
Right.
Nike, it's a swoosh symbol. Who cares? It's the brand represents something. That's all that's all it is, right?
No, I just love your insight. And Tim, I'm going to make sure everybody has your LinkedIn information in the show notes and everything else. And what do you project the rest of the year for royalties? You think it's going to be great for the next couple of years?
Yeah, I mean, listen, I'm not going to sit here and be a prophet because I'll probably be wrong 100% the next month. But I think I think there's a couple of things that are interesting. There's drilling activity. There's folks' portfolios that are starting to produce great returns on cash flow alone, and oftentimes you get to, we'll call it a rough rule of thumb, around 40% PDP.
Right.
With a decent amount of ducts and permits, and then upside, that's kind of your optimal time to sell out when you have a larger portfolio.
Right.
Now you're sitting there, and I think a lot of folks are starting to contemplate, well, shit, do we cash flow this out? We can hit our hurdle rates by just cash flowing it out, and then we're playing with house money. We can only sell when it's optimal.
Right.
I think you would, it might be counterintuitive. You'd say, well, if prices are so high and cash flow is so up, you can get an insanely high number. Why wouldn't you sell the top or the perceived top? And I think the answer to that is buyers they don't really know what strip to use or how aggressive to be. Or, you
Right.
look at the forward curve and it's gas drops off to $4 like very quickly. And so you think to yourself, do I want to sell based on that, or do I want to roll the dice a little bit and maybe in a year or two I'm still getting $6, $7, $8 in MCF? So I think the dynamic to watch is the larger M&A space.
Okay.
And how do we stabilize at these higher prices, which enable people to transact and hedge accordingly, or do we see a lot of folks starting to hold on and really grow these large cash flowing
Nice.
beasts? And I think fast forward 3-4 years, if that's the case, you don't see a lot of exits. Then it becomes really interesting at that time that they get merged into public companies, and then the public companies start to get scale because they're kicking out so much yield, and that becomes a better product for the end buyers to then take on without having to underwrite a lot of undeveloped risk. And then the other is going to be on the fundraising side. So, getting investors really looking for this inflation hedge, and looking for exposure to oil and gas, and in a way that they weren't before. Either just the returns are so good, or the rhetoric of the Ukraine war might change people's perspective on oil and gas and not vilifying it as much, right? Because
Right.
whatever you want to say, definitely Europe has put itself in a very vulnerable position geopolitically by relying heavily on renewables development. And you're you're at the crux of being at war with Russia, but also needing their natural gas. And so that, I think, might change the tune. It's definitely changed the tune of a lot of investors in Europe already. They're changing their tunes there, and you start to see high gas prices at the pump, and a lot. There's been a, like in any war, and I think social media really magnifies this, is the humanitarian aspect of, pray for Ukraine, support Ukraine, all this stuff, which I think is phenomenal. And because of social media, you don't have to rely on the central media channels to distribute what's going on. That all in itself may change the sentiment from the broader public on, hey, natural gas and oil development could play a role in helping this situation, or quote unquote punishing Russia for its inhumane actions, right? So we'll see from a fundraising standpoint how much money comes into the space, what type of money comes into the space, and how that coincides with the ability to put the money to work. Given transactional activity is always hampered with volatile prices. So those are the main things I watch. But at the end of the day, Stu, I mean, there's always deals getting done. There's always people being innovative. Whenever you think something is completely, there's no more opportunity always kind of reinvents itself. So that's what keeps me waking up every morning excited. I live and breathe on the telling me what's going on, and so it's a lot of fun to stay plugged into that, and to do the content and private conversations and dinners and all that day to day. So we'll see how everything unfolds.
Well, I'll tell you what, thank you, Tim, for stopping by the podcast today. And I just really had a lot of fun, and look forward to visiting with you again in the future as we start running down the road there. So thank you very much for stopping by.
You bet, Stu. Thanks for having me on.